HMRC doesn't need suspicion to start paying attention. They need inconsistency. Let me walk you through the 5 red flags that often trigger HMRC investigations and how to stop it escalating. I'm Salman Anwar, an ex-HMRC tax inspector. I worked at 2 of the largest accountancy practices in the land. I now help landlords, business owners and entrepreneurs save tax. The first red flag I want to highlight is unexplained money flows. Money hitting your account that doesn't match the returns. This catches directors, landlords and contractors constantly. Not because the amount is huge, but because the story doesn't add up. If the return says one thing, but bank credits, platform payouts and other incoming suggests something else, it creates a flag. HMRC doesn't ask where every pound comes from, but they notice when pounds appear without explanation. What happens next? Usually, the next step is an innocent letter asking you to clarify. This might be an opening investigation letter, it might be a nudge letter, and so on. And this is where most people widen the scope. Quick test. If HMRC asked you tomorrow what this £12,000 credit is in your bank account, could you prove it in 60 seconds? If the answer is no, that's a risk. Separate personal and business bank accounts. Label your transfers, keep evidence of gifts, loans, refunds or one-off items. If it's not income, document what it is thoroughly. Red flag number 2, late filings, constant amendments and scrappy records. One late return isn't the end of the world, but repeated lateness is a pattern and patterns are what trigger compliance reviews. Consistency builds credibility. Inconsistency invites scrutiny. File on time even if you can't pay. Keep bookkeeping monthly. Sloppiness is what turns small issues into big ones. Having good financial controls, solid records and explanations at the ready, it's what's going to keep you safe from HMRC. Red flag number 3. Expense claims that don't align with reality. HMRC benchmarks. They compare you to others in your industry. They have the data on every single business in the land. If yours doesn't match up with your competitors, with the business down the street that's doing the same thing as you, no doubt HMRC is going to pick that up. If you're earning 60k, claiming 40k in expenses every year, HMRC asks a simple question. What are you living on? What's left? What happens next? Once expenses are challenged, it often expands into bank statements, personal spending and source of funds. Remember, HMRC will ask you whatever is reasonably required for purposes of checking your tax return. If it's reasonably required, they are entitled to ask you. I've seen people investigated when there's no scheme at all, just numbers that look weird. The returns didn't look like tax planning, it looked like confusion. Claim what's legitimate. Keep receipts, don't inflate mileage, don't guess home office use, and don't take TikTok deductions into tax returns. Keep solid records, once again, keep robust explanations at the ready, and ensure where you need to, you seek advice from your advisor. Red flag number 4. Cash-heavy activity without strong records. Cash isn't illegal, but cash without structure is what often causes problems. HMRC will look at whether your declared turnover is plausible based on activity. It gets merchant acquirer data, so your card machine provider, your supplier invoices, stock movements, staffing, opening hours, you name it. The list goes on and on. HMRC will look at these and see whether what you're declaring as your turnover adds up. Remember, the key issue isn't that it's cash. It's that it's not documented very well. It's that your governance procedures are lacking. Record cash daily, reconcile regularly. Make sure your purchases and your stock broadly support the sales you're declaring. Remember, cash isn't illegal, but not being able to explain where it comes from and how you handle it is going to cause some issues with HMRC. So the key takeaway here is keep good records for your cash, document when it comes in, document where you spend it, document when you bank it. Red flag number 5, lifestyle that doesn't match declared income. HMRC isn't judging your holiday photos. They're testing whether your declared income can fund your lifestyle. If there's a gap, HMRC doesn't need certainty. They just need a question worth asking. If funds are legitimate, inheritance, gifts, loans, document them. Without evidence, HMRC can assume income. It's something I used to do all of the time. You break records by checking what's there or what you think is missing. Once you get over that hurdle, everything else is an educated guess. Here's the part most people miss. HMRC doesn't need to prove anything at this stage. They just need enough to open the door. If any of these sound familiar, don't panic, but don't ignore it either. Please don't improvise. And the biggest damage happens after HMRC contact, when people overshare, guess, or try to explain things they can't evidence. They do so without specialist help or even talking to their accountant. Remember, early response shapes outcome. Get your facts straight, put the evidence together, and respond strategically, not emotionally. These red flags don't mean guilt. They mean attention, and attention can be managed if it's handled properly. If you've had HMRC contact or you're worried you're exposed, deal with it early while you still have choices. If you need to make a disclosure, act promptly and do so voluntarily. If you know your record keeping isn't up to scratch, get the right help, get the right advisors and accountants and bookkeepers to make sure your record keeping is brought up to scratch. If you're not using the right tools, start doing so now. Remember, the best course of action is to proactively manage your risk. I'm Salman Anwar. Thank you for watching. I'll see you on the next one.